Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now this is the last and final video on problems on valuation of goodwill. So far 13 problems I have completed on this topic of valuation of goodwill. Now in this last video 14, 15, 16, 17, these 4 problems I'm going to complete. So if you're watching all the videos, now you are in a position to solve any problems on valuation of goodwill. So if you want the perfect knowledge, perfect command, watch all the videos from beginning till end, don't skip in between. And the problems are based on the theory. Until and unless you're conceptually clear about the concept, you should not go for the problems. What is goodwill? What is the nature of goodwill? What is the need for calculating goodwill? What are the methods of calculating goodwill? What factors are considered for calculating goodwill? All these things I have already explained. So if you have not watched, go to the playlist of my channel, select the subject Advanced Accounting New. Watch the video on goodwill. Be perfect about the concept, then you can understand the problems. Now before starting the 14th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep it ready. Take the screenshot of the points, then I'll explain every point in detail. Now, see the 14th problem. Problem number 14. The balance sheet of A Company Limited discloses the financial position as on 31st December 2005 as follows. So balance sheet is given equity and liability, shareholders fund, share capital, reserves and surplus. Non-current liabilities are not there. Current liability, trade payable, short-term provision. This is the liability side. Now assets, non-current assets. Fixed assets are tangible and intangible asset. An intangible asset consists of goodwill. Next page you can see. The current assets are inventories, trade receivable, cash and cash equivalent. The total of the balance sheet is 5,10,000. Now notes to accounts. Share capital 30,000 equity shares, reserves and surplus, capital reserve, P&L account. Trade payable consists of sundry creditors. Short-term provisions consist of provision for taxation. Tangible assets consist of land and building, plant and machinery. And trade receivable consists of book debts minus provision. You are asked to value the goodwill of the company for which the following information is given. The reasonable return on average capital invested in the class of business done by the company is 12%. So 12% is the NRR, normal rate of return on average capital invested, specifically given in the problem. So we need to calculate average capital employed. Adequate provision has been made in accounts for income tax and depreciation. This is only an information. And the tax rate, the rate of tax may be taken as 50%. That means the current year provision for taxation is given 55,000. Current year provision. And the tax rate is 50%. When the tax rate is 50%, the provision for tax and the profit after tax will be equal. Example, if the profit before tax is 1,10,000. 1,10,000 is the profit before tax. On that 50% is tax payable. So 1,10,000 into 50%, you will get 55,000. So out of 1,10,000, 55,000 is the provision for tax. And remaining 55,000 is the profit after tax. So we can say current year's profit after tax is 55,000 because provision for tax is 55,000 and tax rate is 50%. The average rate of dividend declared by the company for the past few years was 15%. This is just an information, not required. Goodwill may be taken at 3 years purchase of super profit. Specifically given, we have to calculate the goodwill according to super profit method. Multiply 3 years purchase. So calculate the super profit, multiply by 3. So before calculating goodwill, first we need how much is the capital employed and how much is the average capital employed. So first we find out capital employed. Assets, land and building, plant and machinery, inventories, trade receivable, cash and cash equivalent. Whatever is given in the problem, same assets values I have taken. Outside liabilities are only two: sundry creditors and provision for taxation. These two are the outside liabilities. Deduct, we get the capital employed 3,56,000 at the end of the year. Now from this closing capital, we have to deduct half of the profit earned during the year. But profit earned during the year not given. Indirectly it is given. How? Provision for taxation is 55,000 and the tax rate is 50%. That means 55,000 is 50%. The remaining 50% is again 55,000, that is profit after tax. The provision for tax for the current year 55,000, tax rate is 50%. Therefore, profit after tax of current year will be 55,000. Right? Now, capital employed at the end of the year 3,56,000, out of which half of the current year profit we subtract. The half of the current year profit is 55,000 into half. 27,500. Deduct 27,500. 3,28,500. This is the average capital employed or average capital invested. Now, normal rate or normal profit is equal to average capital employed into NRR, normal rate of return, which is given in the problem 12%. So 3,28,500 into 12%, 39,420 is the normal profit. Now we need the FMP, future maintainable profit. FMP is the past average profit adjusted for future changes. But in our current problem, past profits are not given. So we cannot calculate average past profit. So we can take the current year's profit as FMP. The current year's profit is 55,000. Current year's profit after tax is 55,000. That itself we can treat it as FMP. Super profit, FMP minus NP. So FMP 55,000 and NP is 39,420. Deduct, we will get 15,580 as the SP, super profit. Now simply we substitute in the formula goodwill is equal to super profit into number of years of purchase that is given in the problem 3 years. So multiply 15,580 into 346, 740, that's all. This is the end of problem number 14. Now see the 15th problem. A company desirous of selling its business to another company has earned an average profit of 1,60,000 per annum in the past. It is considered that such average profit fairly represent the profit likely to be earned in future, except that. So a company desirous of selling its business to another company has seen that their past average profit is 1,60,000 and they think that this 1,60,000 is going to continue in future also, except some changes. What are the changes? Directors' fees of 15,000 charged against such profit will not be payable by the purchasing company whose existing board can easily cope up with the additional administrative work at the present fees payable to the directors. Now, in the previous old company, 15,000 was the directors' fees paid in the past. But in future, this 15,000 need not be paid because existing directors can cope up with the additional work. So in that case, we don't have to pay 15,000 rupees as director's fee. Now rent of 25,000 per annum which had been paid by the vendor will not be a charge in the future, since the purchasing company owns its premises and can supply the accommodation necessary for the staff and equipment of the vendor company. One more expenditure which was incurred in the past need not be paid in the future. So these two expenditure, that is director's fees and rent, these two expenditure need not be paid in future. So this will be added to the past profits. The value of the net assets, net tangible assets of the vendor company at the proposed date of sale was 18 lakh. And it was considered that a reasonable return on capital invested in this type of industry was 10%. No need to calculate capital employed. It is given. The capital employed is 18 lakh and the NRR is 10%. So 18 lakh into 10%, 1,80,000 is the normal profit. Calculate the value of goodwill by capitalization of expected future net profits. So we have to calculate by capitalization method. So according to capitalization method, goodwill is equal to super profit by NRR into 100. That is the formula for goodwill. Now see here, step by step. Normal profit is equal to capital employed into NRR. 18 lakh into 10%, 1 lakh 80,000. We got the normal profit. Now FMP. Average profit of the last few years, 1 lakh 60,000. Now two expenses which were paid in the past need not be paid in future. That will be added. So director's fees not chargeable in future, rent not payable in future. So FMP will be 2 lakh. We got FMP, we got NP. So super profit is equal to FMP minus NP, 20,000. Now goodwill, according to capitalization method, the formula is super profit by NRR into 100. Super profit 20,000, NRR 10%. 10 into 100. You will get 2 lakh rupees as goodwill. That's it. This is the end of problem number 15. Now, 16th problem. Ascertain the value of goodwill according to capitalization method. Again, same way. Shareholders fund, share capital, reserves and surplus, non-current liabilities are not there. Current liability, trade payable, other current liabilities, fixed assets, tangible, intangible asset, goodwill. Inventories, trade receivable, cash and cash equivalent. Notes, share capital, reserves and surplus, trade payable. Then sundry creditors. Current liability consists of bank overdraft. Tangible assets, building, machinery, cash and cash equivalent, cash in and cash at bank. The company commenced operations in 2004. The profits earned before providing for taxation have been as follows. The last 5 years profits are given. 2001, 65,000. Then 2002, 60,000. Then 2003, 70,000. 2004, 80,000. 2005, 1 lakh. The profits are fluctuating. So we can take the simple average, not weighted average. You may assume that income tax rate of 50% has been payable on these profits. The average dividend paid by the company for 4 years is 10%, which is taken as a reasonable return expected on capital employed in the business. So 10% NRR and tax rate is 50%. That's it. From this, we have to calculate the value of goodwill according to capitalization method. So first we need capital employed. As usual, take the assets, building, machinery, inventory, trade receivable, cash in and cash at bank. All the values are given. Take the total. Outside liabilities are sundry creditors, bank overdraft. Take the total. Capital employed is 3 lakh. Now normal profit. Current year's profit is not given. That's why we take capital employed. So capital employed 3 lakh into 10%, 30,000 as the normal profit. Now FMP. For calculating FMP, we need the average profit of the past few years. Here 5 years profits are given. Simple average, because the profits are fluctuating. Average profit 75,000. Minus income tax is payable at the rate of 50%. Because these are the profits before tax. Now 50% tax, 37,500 is the profit after tax. This is the FMP. Because no future changes are there. Simply we take the past average profit, 37,500. So super profit is equal to FMP minus MP, 37,500 minus 30,000, 7,500 is the super profit. Goodwill. According to capitalization method, goodwill is equal to super profit by NRR into 100. So 7,500 by 10 into 100, 75,000, finished. This is the end of problem number 16. Now last and final problem, 17th. Mr. Wiseman has invested a sum of 2 lakh rupees in his own business, which is very profitable one. The annual profit earned from his business is rupees 45,000, which includes a sum of 10,000 received as compensation of part of his business premises. So how much amount he has invested? 2 lakh. And annual profit is 45,000, which includes a sum of 10,000. So we deduct 10,000. As an alternative to his engagement in his business, he would have invested the money in long-term deposit with bank, earning a normal rate of interest 10%, and also could engage himself in the employment, thereby getting an annual salary of rupees 7,500. Considering 2% as fair compensation for the risk involved in the business, calculate the value of goodwill of his business on capitalization of super profit at normal rate. So here normal rate of return consists of normal rate of interest plus rate of risk return, 10 plus to 12%. This is the NRR. And normal profit is equal to capital employed into NRR. That is 2 lakh into 12%, 24,000 normal profit. Now, annual profit 45,000 minus compensation for the part of the business premises 10,000. Deduct. So, annual salary foregone by Mr. Foreman 7,200. So, FMP will be 27,800. So, we got FMP, we got a normal profit. So, super profit 3,800. Goodwill as per capitalization method, super profit by NRR into 100. 3,800 by 12 into 100, 31,667 is the goodwill. This is the end of problem number 17. So we have completed the chapter theory as well as problems on valuation of goodwill. Inshallah, we'll continue the next topic, valuation of shares, in the next video. So if you're satisfied, give a like to the video, share my channel among your groups, among your friends, so that more students can watch the video. Subscribe my channel if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue in the next video.